Brilliant. So I think we're live now. It's 7 o'clock, so we'll begin. Thank you everyone for joining, and welcome to Arch 123 Yeet for joining us. Lovely to see you, and all of the regulars and any pension crafters who are on. I appreciate you joining us as well. Now, which other finance YouTubers do you follow? Ooh. Not many, actually. I usually look at things like news, so things like the FT. It's often interesting to look at what Ray Dalio is saying, just out of interest. But in terms of following people, I don't generally follow many finance YouTubers. That's not a kind of unpleasant thing to say about them. It's just I don't usually get much out of it. I usually go for primary sources, usually. So that's where I get most of my information from. Okay, so usual thing that we do, which is to, if you want to ask a question, just stick it into the chat. I'll try and answer as best I can. And please do like the live stream, because obviously that gets us more views. And I should also say that, you know, obviously this is for free, but we provide premium services, so you can support us on Patreon. And if you do that, it's $10 a month. You get to join us on a Sunday evening call, and there are much fewer people on that call, which means you're much more likely to have your question answered. Plus, I probably know you, so you know, it's easier to answer people which you know. We also have the weekly roundup email, which is free. And there'll be a link to it in the description below, where we talk about macro stuff and about markets and how the two interact. And of course, you can have a one-to-one with me, where we can discuss anything you like, but no advice. It's just education. So all of the links to those things will be in the description of the video. So do have a look there. And yeah, if you do want to kind of jump to the front of the queue when you ask a question, you just need to have a super chat. You have to pay for that, but it means that we'll go straight for your question. I'm afraid, you know, if you're paying, then, you know, you do get to the front of the queue. So let's just have a look at the questions. Pedro Montano says hello from Bristol. Hello, Pedro. Welcome to the early birds. Yeah. Okay, so thank you for going live. If you were buying your first home, this is from Will, within the next 2 years, is this sensible to purchase some equities within this time frame, potentially capitalizing on the market lows? So what we're talking about here is buying equity for a deposit, presumably, on a house which you're going to buy in 2 years' time. Now, beware of using equity markets for something where you need it in less than 10 years, because over a 2-year period, equity markets, just from their nature, are very volatile. So it may be that the amount you put in, the equity market could fall below that level over that 2-year period. And then if you need the money at that point, you'll have to sell at a loss, you'll crystallize your loss. So generally, you should be more cautious with equity if you are going to be investing for a short period of time, where short is less than 10 years. So be really careful about that. So if you are going to put the money aside, you definitely want to have a fair chunk of bonds in that portfolio. And for over a 2-year period, I'd probably put the vast majority of it into bonds, because at least then it won't fall. At least it won't crash. So I'd be very careful about equities over a 2-year period. My pleasure, Archie. Thanks for the welcome. Hello, Rachel. Hello, Tom. What's your forecast for sterling amid Brexit scenario? Okay, well, I don't make forecasts. As any of you who watch me regularly will know, that's not what I do. I usually talk people through drivers, or at least what drives market variables, so that you can make up your own mind about what drives sterling. So let's go through sterling drivers right now. For currency, what generally drives things long term is the interest rate differential. So if you have a currency which has a very high interest rate versus one which has a low interest rate, money tends to flow from the low interest rate to the high interest rate country, and then the currency of the high interest country appreciates versus the low interest country. So let's say the US had much lower rates than the UK. If that was the case, the money would tend to flow to the UK and it would strengthen sterling versus the dollar. But there are other considerations. Now, just like there is with equity, currencies fall into riskiness categories. Now, certain currencies are seen as risky and others are seen as safe. So in the safe camp, you'd have the yen, the Japanese yen, the Swiss franc, and the US dollar. Those would typically be seen as safe haven currencies. So when people are scared and equity markets sell off, people buy those currencies. Now, the sterling used to be a safe haven currency, but after the referendum in 2016, it started having much higher volatility, and people started to price in the negative growth effects of Brexit. And when that happened, sterling devalued significantly. And so I think if you think it's going to be a bad trade deal, then probably sterling could weaken further. If it's going to be a good trade deal, then sterling will rally. There's a lot of upside potential if that's the case. And generally, if you do think sterling's going to weaken, then you put more money into foreign assets because they gain in value. If you think sterling's going to strengthen, you'd keep it in domestic currency or hedge. So that's the kind of very, very quick overview. Growth also matters. So when a country has high growth, it tends to push up the interest rates and strengthens the currency. But obviously in the UK, given what's happening with COVID and also what's happening with Brexit, it's unlikely we're going to get huge growth in the near future. So certainly relative to other developed markets. So, the outlook for sterling doesn't look particularly good at the moment. So no forecast, but hopefully that's helped you, Alex, to kind of make up your own mind about what's going to happen to sterling. Okay, what typical return one should expect from a bond fund in this environment? Well, it really depends on the kind of risk you're taking with the bond fund. That's Zishan, Ramin. So the lower the risk, the lower the return you'd expect for the bond fund. So the safest thing of all would be government short-dated bond funds. So here the maturity would be less than a year. And effectively that's a money market fund. So that hardly changes in value at all over time. So your return would be very low. We'd be talking about less than 1%. But would it crash in value? No. It's a very, very safe investment. If we extend the maturity of the government bonds, then you're taking more duration risk, and a higher risk means a higher return, probably. But also there's the potential of a bigger capital loss. So that's the drawback of greater duration risk. And then we move away from government bonds, which are very credit worthy in developed markets, and we might move to corporate bonds, so investment grade corporate bonds. And there you'd add a little bit of spread for taking the corporate credit risk of high credit quality companies. And at the moment, you'd probably add at most 1% extra income for taking investment grade credit risk, given the current market environment. So you'd be making 2% tops, I'd say, for investment grade credit in the US, for example. And then we'd move to something even more risky, which would be something like emerging market government bonds, where you're lending money to countries like China, Mexico, Brazil, Russia, and they have a higher probability of defaulting on their debt. So consequently, they have to pay you a bigger coupon to take that risk. And there you might make, say, 4% or maybe even 5%. But you're taking a much bigger risk because particularly in an environment like this, where we've had a big growth shock globally, those countries may not be able to service that debt, and we could trigger a crisis in sovereign debt in emerging market current countries and currencies. So that may be a consequence of this growth shock that we've seen. So it really depends where you take your risk in the bond fund market. Or you could go for junk bonds in developed markets, where you could also earn about 4 or 5%. But there you're taking much greater credit risk. And some of them have a lot of energy exposure. So a lot of energy companies like Chesapeake has just filed for Chapter 11 bankruptcy. And there probably will be others which do the same thing. So you have to be very cautious about high yield in this kind of environment. Spreads could widen quite quickly, despite the Fed's purchases. So it really depends on what you buy, is what I'd say.
Lots of people to like.
Please like the stream, because if you do, then other people may see this stream. And obviously it helps us a lot if you like it. Currently we have 73 likes, but hopefully that's going to go up if more people like it. So please do like it. Yeah, that would be great. I may have to call out the big guns now. I might have to call my dog over. Ted, treat, no, here. Ted, oh dear, he's gone for the window. Right, that's absolutely useless. Ted, treat. Look, it's here. Yeah, he's a bit camera shy, I've got to say. Okay, so next question. Do you think that it would be a good time to buy your first home in the next 1 to 2 years if mortgage interest rates stay low and the housing market falls like in every other recession? Well, if it did fall, that would be potentially a good time to buy. And this is one of the weird things about the housing market, which is that, you know, if you do get a crash, then it's obviously good for first-time buyers, in the same way that an equity crash is good for people who are buying equity. Are we going to see a crash in this environment? I think it's certainly not a good period for house prices for a number of reasons. And the obvious one is unemployment. We've seen unemployment increase all over the world, some countries more than others. So, for example, Japan hasn't been as hard hit. Europe hasn't been as hard hit. Whereas the UK, it's looking like we're getting an increasing number of layoffs. Because many of these companies, like restaurants and service industries, on which we're very dependent, many of them are customer facing. And they've had huge cash flow problems despite the government's furlough schemes. And so it could be the case that, you know, with higher unemployment, that would weaken house prices in the UK because less people can afford house prices. People are going to be more uncertain because they'll be worried about losing their own job. And that makes them less likely to go into something which is going to load them with a lot of debt. If you're worried about losing your job, you may not go for such a big mortgage or go for a mortgage at all. So this is not a good environment for house prices. But one of the difficulties is that the liquidity of the housing market was very low. There were very few transactions. The ONS had to actually stop publishing its house price index because it didn't have reliable data. There were so few transactions during the lockdown. So at the moment, it's very hard to know what the effect has been until we see a higher volume in those markets. And of course, they don't update very often, the house price indices. So it is difficult to gauge what the effect's going to be, but I suspect it'll be negative. But the positives are interest rates are still very low, and they're probably going to be low for a long time because the Bank of England, the Fed, other central banks can't raise interest rates while we've got this growth problem. And the other positive is that there's very little supply in the UK, at least, of new housing, which means that the demand is still there because we carry on living. You know, people carry on having families and life goes on. And, you know, there'll still be a demand for housing, but very little supply. So that's a positive. So low rates, lack of supply, that tends to push prices up. But a recession, which we're currently in, job losses, higher unemployment, that's a negative. So really it's a kind of tug of war between those factors. I think those are the primary ones. Okay, so if you do want a question answered and you want to kind of jump to the front of the queue, then why not use Super Chat? It's very easy, and you have to pay, but it means your question gets bumped to the front. So if we can get some more likes, oh my goodness, we've got 123 already. But it would be great if the remaining people could also just like it. It's dead easy, just like, and then other people will be able to see that you've liked it, and the algorithm at YouTube, and to which we're all in thrall, will favour this video as other people watch it. So that would be great. Right, next question. Yes. Thanks for doing these. Have you any thoughts on the dollar milkshake theory? Brent Johnson's many thanks. I'm not aware what the milkshake theory is, I'm afraid, so I couldn't comment on that. What do you think of the unemployment rate down to 11.1? Is it a good time to go back into the market? So this is the employment data which we got today. A bit of product placement there. You'll notice it's not 7-Up today. It's Fanta. Okay. Yes, the unemployment data. So obviously it was very positive. We got a big jump up in unemployment data. I can probably share my screen with you just so you can see what I'm talking about. Let me share my screen and I'll do a picture-in-picture. So this is the unemployment rate in the US. Now at the peak of the previous crisis, the unemployment rate reached 10%. Currently, it peaked at 14.7. It was probably higher than that, but it was miscounted. Then it fell to 13.3 last month, and this month it fell to 11.1. So we're still above the peak after the global financial crisis. It is falling very rapidly, and it's a positive, obviously. The thing which everyone's looking out for is scarring. In other words, how far will it fall and how long will it take to get there? Because if this does last for some time, and it's likely, let's be honest, that unemployment is going to stay high for some time, because we're going to see this ripple effect as more regions lock down, and then they come out of lockdown, but then you get a spike, and then you get another lockdown. While that rippling goes on and the fundamental problem remains, people will still be cautious and activity will still be limited. So the question is, how far will it fall and how quickly? But it is a positive. There's no question about that. And the unemployment data was strong. So we saw 4.8 million jobs added, according to Fred. And according to the Bureau of Labour Statistics, this is the actual survey, 4.8 million jobs added in June. And so that is a positive. But my worry is that we're going to get this scarring effect. So, yeah, I temper that with perhaps more caution, because it really depends on how low it falls and how quickly. So let me go back to the questions. Yeah, I guess the other part of your question was, is it a good time to get back in the market? You know, any time is a good time to be in the market, because you can't time markets. And generally, it's a good idea to be exposed to equity, because you don't know when it's going to crash. And if you hold back your money thinking there's going to be a crash, some people miss out on entire rallies or an entire decade's rally because they don't commit any capital to equity. So really, for most people, it's best to just ignore the news and carry on drip feeding into your portfolio, because markets obviously suffer sell-offs, but generally over the long term, the optimists prevail. Equity does rise. If it's a developed market equity, if it's the US as well, then generally they rise over time, and it's best to be in the market for as long as you can. People try and time market, but they generally fail. So I would say any time is a good time to get in the market. Maybe if you've got a huge lump sum to commit, You wouldn't put it all into equity, probably, unless you have a very long investment horizon or you're very young. Maybe you'd want to be a bit more guarded in that case. But if you have a lump sum, you'd have to think about your risk appetite, your capacity for risk, all these things. Really depends. Right, next question. How have you rebalanced your portfolio going into Q3? What are you invested in? So again, this is a matter of public record. If you look at my portfolio, the last video I made, I haven't changed my portfolio. I'm 20% equity, and that's in a global minimum volatility fund. And I have 40% in UK long duration gilts because I want an equity hedge and I want a little bit more income than I'd have for the shorter duration government bonds. And if you go further out on the curve, you get a slightly higher compensation but higher volatility. And then I've also got 40% in US government bonds, treasuries, but it's sterling hedged in case sterling rallies. So that's my portfolio. 20% equity, 80% government bonds. Paul says, why always Vanguard? Well, unfortunately, or fortunately, that's who I have my money with. I don't have any payments from Vanguard. I always try and stay independent. I don't get paid by platforms in order to promote platforms. Vanguard's one of the cheaper ones. I like their approach to investing. I like their commitment to low fees. But it's getting to the point now where it would be almost as cheap to be on another platform, like Interactive Invest, for example. I'm certainly not tied to Vanguard in any way. So I quite easily change away from Vanguard. Nice picture of a Labrador, by the way, Paul, on your icon. I like that. Okay, so Zishan says, I've been saving cash for a while, but could not catch the pace with the house price rise. What would be a sensible option to invest at this time? Impossible to say what you think would be sensible. There are certain aspects of investing which never change, right? You always want to be diversified because you don't know what's going to outperform. So choose investments so that you think they have a fairly good prospect in the future. Usually that means equity. Usually it means globally diversified equity. And then have some bonds as well in order to diversify your equity. The amount of bonds depends on how much risk you want to take. So the more equity you have, the more risk. 100% equity is riskiest. And as you dial down the equity, it gets less risky, but the ultimate long-term return reduces. So really that's the trade-off, risk and return. But in terms of what you should do, I really can't say. You'd have to gauge your own risk appetite, your risk capacity, which only you know. So at the moment, things which look interesting are fairly limited because I think valuations for equity are very high, and so it's very difficult to justify, I think, having a very large equity allocation with the expectation that that's going to give you very good returns. Because when valuations are high, usually that reduces the long-term, say decade-long returns that you get for equity. But I wouldn't hold back my investments because of that. If you are somebody who's drip feeding your money into your savings, well, probably it's best to just stick with your strategic weights, your long-term weights for your portfolio. If that's 60% equity, 40% bonds, you'd carry on drip feeding into that portfolio in that ratio. So please do like this stream. We now have 320 concurrent viewers, and only half of you have liked this channel. So please do like it. Makes a big difference to us, and it's just one click for you. That would be great if you could like it.
Talk about the benefits of...
Oh yes, the benefits of membership. Yes, because we now provide unique videos which you can only see if you're a Patreon supporter. So for example, 2 this week were on your investment journey, if you like. So you start off simple, where you just have funds in you just have a single fund which is globally diversified. And then as you get more confident in investing, you can go for a kind of core satellite approach where, you have your diversified core, but then you have kind of satellite investments which you think will add to the return or just add to interest. It's kind of interesting to be exposed to slightly more risky things, but which are interesting things like Tesla or Bitcoin or whatever your pet interest is at that time. But the core you keep diversified. So that's one of the videos I did this week, which is only available for Patreon supporters. Also, there was one about correlation and drift, because those two are very important when you diversify. And there was an interesting question about that from one of our supporters on the Slack channel. So I made a video about that. But we churn out 2 of those every week. And what we're doing is building up a library of those so that when people ask us a question, we can just point them at the relevant video. You also get access to Slack, the chat application, where you can ask questions of me or anyone else. And you also get the Power Hour every other week or regularly anyway, so that you can ask questions like this, but there are less of you, so you're much more likely to get your question answered. Also, thank you for liking. We just reached 200 likes. That's great. Thank you very much for that. That's really kind. So let's just move on to the next question. And remember, you can do a super chat, in which case you get pushed to the front of the queue for a question. Right. What's your thoughts on gold and silver and Bitcoin over this time of madness? If only I could buy commodities. I can't because I'm with Vanguard, but Vanguard is not keen on gold, so they don't let you buy it. But in this environment, gold is probably a good investment because rates are low, and when interest rates are low, there's no loss of income by having gold. Gold is a wasting asset. It actually costs you money to hold it because you have to pay the storage costs. And that means that if interest rates for risk-free assets like treasuries are generating, I don't know, let's say treasuries were giving you 5%, then why would you pay for gold if you can have a 5% income generating asset that's risk-free? And the simple fact is most people wouldn't. So in that case, when rates are high, real rates, when you subtract inflation, when real rates are high, that's really bad for gold. But at the moment, real rates are negative or zero. So there's no opportunity cost in holding gold. And people are nervous. People are still buying government bonds because they're scared. They're also buying equity, but they are buying government bonds still. There are big flows into the government bond market. So that's why gold would probably be a good thing to own, because when people are scared, gold rallies. So if we do get another sell-off, it'll be a nice kind of hedge. But as I say, I can't hold it. Silver, less attractive because it's an industrial metal, which means that it is correlated to growth. And we are going through a recession, and there's a lack of demand, and there's not much global trade. So industrial metals won't be performing so well as, say, something like gold, which is more of a kind of fear trade. Oh, and there was Bitcoin as well. I was just looking at the Bitcoin price today. Not great, right? And it sold off during the March tumble in equity markets, which showed that it was a risk-off asset. It was a risky asset, just like equity. So it's not a very good hedge for equity. It is a very risky asset. It's got a very high volatility. And so personally, I never invest in it because the vol is simply too high. 80% volatility is extremely high, much higher than equity. Even during a crisis, it's very rare for equity to have an 80% price fluctuation every year. So yeah, I'm not so keen on Bitcoin. And frankly, this year it's been a bit lackluster. So I suspect it's not as popular as usual. But unfortunately, gold and Bitcoin are very difficult to price. There's no fundamental price because they don't generate an income. So you can't say the fundamental value of it is X, Y, or Z. because you can't discount those future cash flows because there aren't any. So with something with no fundamental value, its price is just what people are willing to pay for it. And that could be anything, right? So I don't like gold for that reason. I don't like Bitcoin for that reason. And if you listen to Jack Bogle, for the same reasons, he didn't like gold. And I think Bitcoin he never really talked about. But Warren Buffett hates Bitcoin. He thinks it's going to end badly. Okay. Okay, what's your expectation about gold price in the next 5 to 10 years due to money printing? Right. I think a lot of people who are gold bugs are very concerned that we're going to get lots of inflation in this environment because they're expanding the supply of money, central banks, with a very simple logic that if you have more currency and a fixed amount of gold, well, then the price of gold will presumably the inflation will spike because there's lots of money, and the amount of goods and services which are around is constant. So it'll kind of drive up inflation. At least I think that's the logic. But I don't really buy into that because a key thing is the velocity of money. And the velocity of money's been coming down. What the velocity of money is how many times a dollar's spent once it's injected into the economy by the Fed, say. Now, in order to get inflation to increase when the Fed prints money, the velocity of money has to be high. But in fact, what people are doing with the money when it's printed is saving it. Just look at the saving rates in the United States, in the UK, and during lockdown, it's gone incredibly high. It's gone to record levels, certainly in the US and I think in the UK too. So I think what's clear is that that's not going to be something which creates inflation unless we suddenly all go out and start splurging cash, which I think is unlikely. Because if you are getting job losses, you're not going to run out and spend your money. You're going to save it because having just lived through this awful period, you'll be thinking, well, if I do lose my job, I'll need that money to live. So I think it's very unlikely that we're going to get a huge increase in expenditure, a hugely demand-driven inflation spike. Demand pull inflation, they call it. I think that's very unlikely in this environment. So the other thing to consider is that generally gold is a very poor inflation hedge. It doesn't go up in value when inflation is high. So even if we did get inflation, gold is not the asset that would benefit. But making a forecast of the price of gold is anybody's guess because, as I say, it has no fundamental value. You can't say it's expensive or cheap because you can't know what its fundamental price should be. Whereas with equity, you can look at equity and say, this is expensive or this is cheap. And at the moment, equity is expensive in the US, for example. So impossible to say. And I never would make a forecast anyway.
Market roundup.
Yes, if you do want to hear what we think about markets and about macroeconomic data, which is coming in, which is being published all the time, then you can sign up to our weekly market roundup. It's free. There's a link in the description of this video if you look below. And it's, we try to keep it interesting. There's usually a funny tweet at the end of it, except for this week when there was the sound of a squirrel making cute noises, but I forgot to put the link in. Sorry about that. But usually you can click on the tweet and there's a funny video. And strangely enough, that's what most people click on. They like the tweet. But we do try to produce content which is pitched at just the right level so that you continually learn about what's going on in the macroeconomic world, but also how it affects markets. And we try to keep it relevant to investors. So we don't just talk about economics for its own sake. Yeah, anyway, so that's free and published every week. We won't fill your email folder full of spam. You know, you only get the odd invite to things like this and the weekly roundup if you sign up for that. Oh, and be aware that it's a two-stage thing. So you say, I want it, you click on the thing, and then you have to send a confirmation. We'll send you an email saying, are you sure? And then you have to confirm. So that's just to ensure that it's done securely. Right, yeah, so do like this. We've got 425 concurrent viewers now and only 220 likes. So only half of you have liked it. So please do like it because it helps us a lot and it's just one click for you. Very easy. Interesting question from Ryan who says firstly that he loves our channel. So that obviously that's going to get your question answered, Ryan. And he says, is value investing dead? I mean, it certainly hasn't been very good recently. If you look at the performance of value through this rally, there have been short periods when rally looked like it was making a comeback. But for many years now, for 5, maybe even longer, value's been underperforming. Growth has been doing much better, largely because of tech stocks, which are obviously growth stocks, doing particularly well, and primarily in the US. So will value come back? Yeah, the story will change at some point. Value did very well for decades on end before this decade of underperformance, but that's the way factors perform. You know, you do get decades of outperformance and then decades of underperformance potentially. So if you really do believe in value investing, then stick with your guns. If you think that the fundamental story hasn't changed, which is that stocks which are undervalued will outperform. But I'd be cautious about it because obviously you're taking more risk by buying a factor fund than just buying a globally diversified fund. You've got to have that discipline to stick with it, even when your factor underperforms. And it only works if you do stick with it. Okay. Do you think digital assets have no future at all? This is Mina Sedom. They're gaining adoption in Germany. Bitcoin's listed on the exchange, Japan and Canada. I think, if you're talking about cryptocurrency, I think that it's probably going to be the case that all currency becomes digital at some point. The question is whether the current implementation of digital currency, is the one that becomes adopted widely. And that's unlikely, I think. Now, the reason for that is largely because I think governments want to control money. And if they see Bitcoin as a threat, then they're not going to do that. They're not going to allow it to flourish. So if it becomes successful, then I think people will try and ban it. I think governments will try and ban it. But again, I've done a video about that if you want to have a look with my views about Bitcoin, which haven't really changed. So there is a super chat, which I'm about to click on and answer. So thank you for asking the super chat. Michelle Neef, who says, is holding more minimum volatility in my portfolio a reason to buy less bonds to achieve more drift in the long run? Thank you. So minimum volatility, just if people don't know, a minimum volatility fund is an equity fund. In other words, it's pure equity, right? And that's the riskier part of the investment universe. It's the least risky part of the riskiest part of the investment universe. So generally it's boring stocks like, I don't know, utilities, defensives, consumer staples. It's kind of boring companies. And it generally tries to find equities which have low correlation with each other, which damp one another's volatility as much as possible. But it's still risky and it's still equity. Now, the bond component in your portfolio, you'll find, if you work out the correlation of that with the minimum vol fund, you'll notice it's very low. Whereas if you compare the minimum volatility correlation with other equity, you'll find it's quite high because it is still equity. So minimum vol isn't bond-like in that sense. It's still equity. It's just less risky equity. So would it be a reason to buy less bonds? Maybe, because it's less risky than equity, which isn't minimum vol. But it would make a huge difference. If you're buying bonds to protect your portfolio if equity sells off, look at how much the minimum vol funds fell. So for example, the Vanguard version, VMVL, I think fell by around 20% when general markets fell by about 35 to 40% in the March sell-off. So it sold off less, but it also rallied less. So it doesn't take away the risk, it just reduces it. So maybe a bit less bonds, but you still need bonds. If you're going to need bonds anyway, substituting minimum vol for your global equity won't take away the desire for bonds, put it that way. It would just reduce it slightly. But for me, you can see, I'm 80% bonds in my portfolio and 20% min vol. Oh, is that another one? Okay. Oh gosh, okay. Product placement, yeah. Okay. Bright and Breezy Felix says, in the UK, is now a bad time to purchase an annuity. Does the guarantee override bond performance? So if people don't know, if you do purchase an annuity, generally this is when you retire, you get paid a fixed amount of money every month for the rest of your life. Now often, in fact usually, they're going to be index linked. So it's going to be linked to the value of inflation in your country. So that means that you're not taking any investment risk. If you don't have an annuity and you just have your pension pot with equities and bonds or whatever, there's always the risk of a shortfall. There's always the risk that you'll outlive your money. That's never the case with an annuity, So is now a bad time to purchase an annuity? Well, let me turn that question around. Now is a worrying time. Okay, economically, the world is in a very parlous state, in a very bad state. We have a synchronized global recession. It does look like we're coming out of it, but it's going to be patchy, the recovery, and there could be accidents along the way. So there is a risk in this kind of environment, or in any environment, that you're going to get a shortfall in your pension if you need it immediately, or if you're not particularly well funded on your pension. So if that is the case, then an annuity at least reduces the worry of not having enough to live off in retirement. But let's say that your pension is hugely overfunded, right? And you don't really need it because you're probably working into retirement, or you may be working into retirement, and you have other sources of income. Well, in that case, you don't really need an annuity. So it really depends on your personal circumstances, but also whether you think the investment pot which you've currently got is likely to suffer a big drawdown in the period that you'll need it. But generally, nowadays, people don't buy annuities as much as they did in the past because now in the UK we have a choice of whether to buy an annuity or not. Previously, we didn't have that choice. So now we've got more freedom, but it makes life more difficult because you have to make your choice about whether you don't want that risk of shortfall, but if you do buy an annuity, you've got no upside. So at least if you have a pension pot and you don't use all the money, then there'll be some left over for your family, which won't be the case with an annuity. So, I mean, those are the considerations I'd say. And I can't really tell you a very clear answer because there isn't one. But those are the considerations that you'd have to take into account. I hope that answered your question. Yeah, so do like this stream. We have 15 minutes left, so there's plenty of time to like it. And we've got about half of the people, a bit more than half the people have liked it. We've got 450 concurrent viewers. And the more people that like it, the more chance there are that other people will join us. So please do share the love and like it. And hopefully we can get that above 400 before we finish the number of likes. Be great if you could do that. Very easy to do. If you're not a subscriber, please do subscribe because you'll get access to all of our videos. There are in the description you'll find links to all of the stuff we offer. We have our online community, Patreon, where you pay $10 a month and you get access to Slack and our weekly call, which is a bit like this but less people. And there's also a link to a power hour, so you could spend an hour of your valuable time with me talking about investment. No advice, just education, so we can talk through your portfolio, the risks of your portfolio, how to diversify, the benefits of different assets and what they mean and how they fit together nicely in your portfolio, but also how macroeconomic data at the moment is painting a picture for different asset types. So any of this kind of stuff we could discuss in as much detail as you like. That would be great if you sign up for a power hour. And you don't have to be a Patreon in order to do that. Anyone can do that. It's £80 an hour for that. Very cheap. Right. So, yeah. And we have a free newsletter, the Weekly Market Roundup, which is also in the description, a link to that. Okay. Scroll down a bit. Oh, Arch123 Yeet says, will mortgage rates drop below 3%? Well, I think, Archie, that rates will stay low for a long period of time. So if you're on a variable rate mortgage, the Bank of England can't raise interest rates, because if they did, many people would find themselves in a situation where they couldn't pay back their mortgage because they borrowed a lot, and their monthly payments will go up. And if the Bank of England raises rates too much, the level of bankruptcies and the number of house repossessions would increase. And a big part of our wealth here in the UK is in the property market. So by raising interest rates too much, the Bank of England will make us all poorer, and that would have a negative effect on the economy. So I think, interest rates on mortgages are likely to stay low for a long time. So I think they're more likely to fall than rise, put it that way. Good question. I'm looking to buy the ARK ETF in the UK. Do you know how I could do that? I'm not familiar with the ETF, Anthony, but with any ETF, you just have to find a platform which offers that fund. And then you can go onto the platform and buy the exchange traded fund. Some things to consider. The platform should be as cheap as possible. So in other words, it should charge you a small fee for holding your investments, preferably less than 0.2% per year. So more than 0.2 would be expensive. And it's probably worthwhile checking that the ETFs you want are available on that platform. So Vanguard, for example, only offers you their own funds. So ARK wouldn't be available on Vanguard. So you have to check it has what you want. So those are probably the considerations. Plus some of them have a trading cost. They have an exit cost if you move your money out. Some of them have an entry cost, which is even more bizarre, as if anyone would be willing to pay someone money in order to use their platform. Bizarre. To enter the platform, I mean. Very odd. But very few of them have an entry fee. So those are the considerations. Somebody says they liked. Several people have said they liked. Thank you for that. Dr. A&B. And thank you, Will. Okay. What's the annual percentage return on your portfolio that you hope to receive? Well, generally, if I receive 5% return on my portfolio every year on average, I think that would be a pretty good result for me, because I don't take a huge amount of risk, and equity over the long term will give you about 5%. Probably. I mean, historically, we've seen much higher rates recently over the last decade, 12, 14%, but That's extremely unusual. Normally you'll be talking about much lower rates. So I think over the last 140 years, the average real rate of return, that's once you subtract inflation, for the S&P 500 is around 6%. So, if I got 5% real return, I'd be happy, very happy with that. So I'm not kind of overly optimistic about that, but, that's what I'm aiming for. What's your expectation about the gold price? We did that. Down a bit. Okay. Elchris 9K, Brian Fitzgerald. Yeah, this isn't a crypto stream, laugh out loud. Very much conventional investing oriented. I'm afraid so. Are stocks less risky because of central bank intervention at times of extreme volatility? Well, yes, because whenever the Fed sees that the equity market's selling off, even though it's not part of their official job to maintain equity prices, people always joke about the put that the Fed operates. So, there was the Greenspan put, then there was the Bernanke put, and then there was the Yellen put, and now we've got the Powell put, with the idea being that it's like a put option where if the price of equity falls below a certain level, the Fed is going to start buying risky assets, which they've started doing, let's face. They've started buying high yield bonds, for example, and investment grade bonds, but also treasuries, as they usually do. That has increased risk appetite hugely. So I think a big part of this rally and the turnaround we saw in March was obviously due to the Fed. So the put has certainly worked. And that does make stocks less risky, definitely, because it restores confidence, it restores faith in the financial system, it ensures that liquidity remains in place. The Fed's made sure that's the case. So markets are functioning efficiently, and they're going to ensure that that continues to be the case. So there's no question, I think, that equity prices are where they are today because of the Fed. So yeah, I think the stocks are less risky because of central bank intervention. Yeah. That was a question from Brett O'Brien. Good question. Dan says, given that tech stocks have grown more than others over the last decade and they're less exposed to virus risks, consumer changes, what are the disadvantages, reasons to invest in non-tech? Okay, good question again. Certainly over the near future, it's very hard to see a world in which tech doesn't continue to do well. It would have to be a very big change in consumer behavior. Now, what could go wrong? So let's go through what could go wrong. It could be that we get some escalation of the trade war in which China refuses to use US tech. And let's face it, most of the tech companies in the world are US based. And if that was the case, then that would be a big negative for the US tech industry. We've seen a situation where people are withholding ad revenue because of concerns about censorship, or a lack of censorship, as it turns out, on social media. So social media, there's no question, they've been used to spread racial hatred. And people have obviously noticed that. And the way you hurt those companies is to withhold your advertising revenue. So I suspect that won't go on forever because we just can't live without some of these companies. It's very difficult to find an alternative because they have such a huge presence online. And it's very hard to find another company which does something equivalent. But yeah, I think it's very unlikely that tech is going to stop outperforming for the reasons which you say, which are that it's less exposed to the virus risks and consumers are certainly hugely engaged with technology. And let's face it, our lives are so much better now because of that tech. It's just so much easier to organize your life and to communicate with people that you want to communicate with because of tech, and we just couldn't live without it now. So it's impossible to put that genie back in the bottle. The only thing that could happen is we'll find alternatives. What I could see happening is that a country like China, who has a huge number of very, very intelligent people, could start producing its own tech giants, and then that would threaten the ascendancy of the US tech industry. So that's one possibility. In fact, I'd say that's quite likely over the near future, 5-10 years. I don't see why it shouldn't happen. So I think that's one of the risks for the US, if you think about it just as a US tech story. Okay. Good evening, Ramin. I know you're quite conservative. Oh, okay. Anyway, I'm FOMO and noticed all markets are hiking at the moment. Do you think BlackRock Consensus 100 is a good choice? And you liked. Thank you very much, Meow Aromdi. Consensus 100. Yeah, I mean, these are the BlackRock funds, which are the kind of alternative to Life Strategy. They're actively managed. They have a low fee, which I love. I think they don't have a UK bias, unlike Life Strategy, which is great. Consensus 100 is a globally diversified 100% equity fund. So, as an alternative to what, I'm wondering. But is it a good choice? Well, it is diversified, it's simple, it's a single fund, but it is pure equity. So that would be my concern. Is that what you want? Do you want 100% equity exposure? Or are you going to have some fixed income in your portfolio as well? In which case you wouldn't go for Consensus 100. You might go for the other Consensus funds, which have lower equity. But yeah, I mean, the fee's low, BlackRock's very well respected, and the fact is that any global equity fund will probably be a fairly good performer. My worry is that it is actively managed and its performance hasn't been good as some of the other global equity funds. So yeah, I might consider whether I wanted something active, but yeah, I mean, it's pretty good. Question from Deirdre O'Connor. What's going on with Wirecard? After their stock bombed and it rallied again, I was wondering if you had any idea why this could happen. Thanks for the Q&A, Ramin. So let's have a quick look at the stock. So let me just quickly find it. And here it is on the SIBO. And I'm going to share my screen. 1 second. Okay. And I'll do it picture in picture. Right, so here it is. Here's Wirecard, and here's its price over time. And this is its price as of yesterday. And you can see that the price has gone down, not quite to zero, but certainly not far off. So the closing price on the 2nd was very low indeed. Right, so it closed at 321 cents. So very low compared to where it's been in recent history. So effectively it's priced at very close to zero. So its value isn't exactly zero. Perhaps people think that it has some chance of surviving this, but it is looking like very likely that people will get none of their money back. That's certainly what the equity market's pricing in. What you can see there is an almost 100% loss. If you look at the equity, if you look at the bond market rather, the recovery rate's much higher. It's about 20 cents in every euro. So people are expecting they'll get about 20% of their money back from the bonds. Because remember, when a company liquidates, the bond payers get paid back first, so they make less of a loss, and the equity investors usually lose everything. So that's what we can see happening with the prices there. Very low recovery rate, if not no recovery in equity, with a 20% recovery for the bonds. So that's what's going on. So I think there isn't a huge recovery in the price there, for good reason, right? Right. So one more question, and we'll end there. So if you do like us, please do. Please like the stream. It's not too late. We've got 500 viewers and only 300 likes. How does that work? 200 of you haven't liked it yet, so please do like it. Okay. So let's end with are there any active funds you like over passive funds? Yeah, I mean, I don't necessarily dislike all active funds. There are some which I love actually. So for example, Scottish Mortgage, I love because it always tells an interesting story. I love reading their annual report. There's been a change in the leadership of the fund recently, but you know, the governance is great because they have brilliant people on the board who can stand up to the fund managers and who have a lot of weight. So they can replace the fund managers, even though they're doing a great job at the moment, they could. So the governance is great. They lowered their fees as they grew, which is fantastic. I mean, they could say, right, we'll carry on charging you 1%, even though we've quadrupled in size. You know, like Fundsmith did. You know, they haven't lowered their fees. They're still charging 1% at Fundsmith. But Scottish Mortgage lowered their fees as they grew, as a kind of thank you, I guess, to their investors. So really interesting investing themes. They've lowered their fees, great governance, and yeah, just overall very interesting fund. Another one I like is Orbis, because Orbis, they give you money back if they underperform. In other words, their fee depends on their performance. And if they underperform, they lose out. So you can bet their bonus depends on their performance. And their company will make less profit if they underperform. Whereas other companies, like Fundsmith, will carry on charge you 1% whether they outperform or not. So I think, you know, those are the kind of funds I'd go for. Something where the fee is not high, so the fees are reasonable, where the fees come down as it gets bigger, or the fee is dependent on performance. And there's a really interesting story about how they invest. I think those are the kind of active funds which I may consider in future. I mean, I don't have any active funds at the moment except for my factor funds, but that's the kind of thing I'd consider. And yes, factor funds are what I own. So they are active in the sense that they don't track an index, but they are kind of programmatic in their approach to investing. So that's it. That's it. Great to have you all ask such amazing questions. I can never believe how good the questions are on these live sessions. So thank you for that. I really appreciate it. And for spending an hour with us, which I really appreciate as well. And for 500 people, oh my goodness, that's very good. That's better than last time. So thank you for joining us, and thank you for all the likes. It's still not too late to like it. So do like it. And yeah, all of the stuff that we offer is in the description. So that's Patreon for $10 a month. You get Slack, get these calls, but on a much more informal and smaller basis. So you get more chance of being answered. You get the weekly roundup, which is free in the description, where you can hear about macroeconomic themes. It's free to sign up. And we talk about markets there. And we get the Power Hour. So you can speak to me directly for a whole hour. If you can imagine the joy of that. Brilliant. Anyway, so thank you all for your time. Great call, great questions, and we'll see you in the near future. Hopefully as a member. Take care, everyone. Bye-bye.